ever feel like you're trying to decipher, a rapidly unfolding story in the stock market?
Yeah, like the important clues are just hidden somewhere.
Exactly, like we're constantly playing catch up. Well, today, on the deep dive, we're maybe handing you a bit of a magnifying glass for that.
Hmm.
We're going deep into the exponential moving average, or the EMA. It's a pretty key tool for traders trying to understand price action.
It really is. And we've been looking at a really helpful video from Stock Sniper Trading on YouTube to sort of frame this.
All right.
Our mission for you, the learner, is basically to give you a clear, insightful understanding of what an EMA actually is, how it works, and maybe most importantly, why it's so valuable if you're involved in market analysis.
Right, cutting through the noise.
Focusing on the core stuff without getting bogged down in like super technical jargon.
Okay, let's dive right in then. At its heart, what is this exponential moving average?
So the EMA, it's a technical indicator. You can select it on pretty much any trading platform. And it just shows up as a line, usually overlaid right on your price action candlestick charts.
Okay.
Think of it as a type of moving average, but, and this is the key part, it gives more weight, more emphasis to the most recent price data.
Ah, okay. So it's not giving equal importance to all the old prices. Like, how is that different from, say, a simple moving average?
Exactly. The simple moving average, the SMA, it just averages everything in the period equally. Every price point counts the same.
Right.
The EMA, though, it's built to be, well, a bit more nimble, more reactive. It responds more strongly to the latest price changes.
Which sounds useful for shorter term views.
Yeah, it can be, especially if you're looking for quicker signals.
And what's the main goal? Like, why are traders putting this on their charts?
Primarily, it's used to help generate potential entry and exit signals for trades.
Okay.
And these signals often come from something called crossovers, which is just when EMA lines of different lengths cross each other.
You'll get into those, I assume.
Definitely. And the good news is the actual calculation, it's built right into the trading platforms. You just pick EMA under indicators. No complex math needed on your end.
That's helpful. Now, the Stock Sniper video, it talked about different time periods or lengths.
Yeah.
Specifically the 9-day, 50-day, and 200-day EMAs. What's the deal with these different lengths?
Right. So traders use EMAs with various time frames. That just means how many past periods, days, hours, whatever time frame you're on, are included in the calculation.
Okay.
And yeah, the video focused on the 9, 50, and 200 as kind of common examples. Each one gives you a slightly different perspective on the price.
Let's break those down. The 9-day EMA first. What does that tell us?
The 9-day is your short-term indicator because it only looks back 9 periods. It's more sensitive. It tends to be more volatile, moves really closely with the recent price.
Right. Sticks close to the action.
Exactly. In the video examples, it was often that yellow line.
Mm-hmm.
And the basic idea is price trading above the 9-day suggests short-term bullishness. Price drops below it, potentially short-term bearish.
Makes sense. Very immediate trend. So what about the 50-day EMA then? That sounds like it's zooming out a bit.
It is. The 50-day EMA, often the blue line in those examples, is more of an intermediate time frame.
Okay.
Because it averages data over 50 periods, it's smoother than the 9-day. It filters out some of that really short-term jitteriness.
It's still used for active trading, though.
Yeah, definitely. Maybe for slightly higher time frame strategies compared to the 9-day, but still in that intermediate zone. And the logic is similar. Price consistently above the 50 suggests an intermediate bullish trend. Below suggests bearish for that time frame.
And then the big one, the 200-day EMA. That feels like it's about the overall long-term story.
That's exactly right. The 200-day, sometimes shown as green, is a long-term trend indicator. It averages almost a year's worth of daily trading data, so it moves very slowly.
Almost looks flat sometimes on short charts.
Yeah, it can seem quite sideways on like an hourly chart. Its real value is identifying the big overarching trend. Is the market generally bullish or bearish long-term?
So price above the 200-day means long-term bullish.
Generally speaking, yes. Consistent trading above the 200-day suggests a long-term uptrend. And conversely, staying below it often signals a long-term downtrend.
Interesting. And I've heard the 200-day is watched by a lot of people, not just short-term traders.
Oh, absolutely. It's a widely recognized level.
Yeah.
Big institutions watch it. Analysts quote it. It can sometimes act as a major psychological support or resistance area, too.
Okay, so these different EMAs give us layers of trend information, but you mentioned crossovers earlier. The video really hit on those. Why are the points where these lines cross so important?
Yeah, EMA crossovers are a really fundamental concept in using them. They can act as potential warning signals that market momentum might be shifting.
Like an early heads up.
Kinda, yeah. The
Yeah.
video showed this well. When a faster EMA, like the 9-day, crosses above a slower one, say the 50-day,
Hmm.
that can suggest bullish momentum is picking up.
A potential buy signal.
Seriously, yes. And if the 9-day crosses above the even slower 200-day, that might imply even stronger bullish momentum.
And the opposite for crossing down.
Exactly. When the faster 9-day crosses below the slower 50-day, it suggests bearish momentum might be increasing. That can be seen as a potential sell signal. We saw that in their GBP/USD 60-minute chart example.
Right.
But, and this is important, not every single crossover means a huge trend change is guaranteed. It's a signal, not a certainty.
So the idea is the short-term trend, the 9-day, is maybe overpowering the longer-term 50-day trend, signaling a possible shift.
Yeah, it's a great way to put it. The faster EMA crossing the slower one suggests a potential shift in the balance between buyers and sellers, maybe the start of a new dominant trend.
Those real-world examples in the video were helpful. Let's talk about that GBP/USD 60-minute chart one. What did we see there?
Yeah, that was a good illustration. It showed a clear bearish crossover the 9-day going below the 50-day. And, well, the price did follow with a noticeable downtrend afterwards.
Okay.
And then later we saw the opposite. The 9-day crossed back above the 50-day, and that seemed to signal the start of an uptrend that followed.
And it also showed the lines acting as support or resistance.
It did, yeah. After the bearish cross, the price seemed to struggle to get back above the 50-day EM. It acted like resistance. And similarly, after the price moved up, the 9-day sometimes provided short-term support, but then acted as resistance once the price fell back below it. It shows their dynamic levels.
And then they had that live trading scenario walkthrough. What were the key things to notice there?
That live bit really drove home how dynamic this all is, and crucially, that you can't just rely on the EMAs alone.
Right.
So initially, price was above both the 9 and 50, which looked bullish. Then there was a quick little crossover that didn't really stick a fake out, almost.
Shows they aren't perfect.
Exactly.
Yeah.
Then a big bearish engulfing candle appeared that's a separate candlestick signal, and that pushed the price down below the 9-day EM.
Okay.
The really instructive part was the first confirmed bearish crossover, 9 clearly below 50. And after that, you saw bearish momentum really take over for a bit.
And the 9-day acted as resistance again.
Yeah, during that little downtrend, the price kept bumping up against the 9-day EMA and failing to break above it. It showed buyers needed to push past that level to regain control.
Then there was a breakout.
Right at the end, yeah. Price broke back above the 50-day EMA, and the commentary was anticipating that the 9-day would soon follow, crossing back above the 50, which would suggest, a potential return to bullishness.
Okay, seeing it live definitely adds context. It also highlights limitations, which the video mentioned. What should we be cautious about?
Yeah, this is super important. The EMA, like any moving average, is a lagging indicator.
Lagging, meaning what?
Meaning it's based on past prices. So by definition, it's always reacting to what has already happened.
Okay, so it's not predicting the future.
Not at all. And because of that lag, it can sometimes give signals late, like after a big part of the move is already finished. Or worse, it can give false signals, especially when the market is just chopping sideways without a clear trend. That's called getting whipsawed.
So we shouldn't just blindly buy or sell every time the lines cross.
Absolutely not. That's a recipe for trouble. The video stressed using EMAs with other tools. Candlestick analysis is a really good partner here.
How do candlesticks help?
Well, candlesticks show you the price action, like right now, within the current period. They can give you much earlier clues about potential reversals or confirmations.
So like if you see a bullish EMA crossover, but the candles look really weak or bearish.
Exactly. That might make you pause and wait for more confirmation, rather than just jumping in based on the EMA cross alone. Candlesticks add that immediate price action context.
Makes sense. Anything else on limitations or best practices?
Just reinforcing that EMAs can also act as those dynamic support and resistance zones. Watch how price reacts when it approaches an EMA line. Does it bounce off or does it slice right through? That interaction gives clues too.
Okay, let's try and wrap this up. What are the main takeaways about the exponential moving average?
Okay, so the EMA. It's a moving average, but it's dynamic because it weights recent prices more heavily.
Making it more responsive than an SMA?
Right. You use different lengths like 9, 50, 200-day to see short, medium, and long-term trends.
And crossovers between these lines are key signals.
They're potential signals, yeah, for possible entries or exits, indicating momentum shifts. But, and this is the big but it's a lagging indicator.
So don't use it in a vacuum.
Never. Always use it with other analysis, like candlestick patterns, to get a fuller picture. and hopefully avoid some of those false signals. Think of it as one tool in the toolbox, not the whole set.
Right. Well, hopefully this deep dive has given you, the learner, a much clearer handle on the EMA and how it can fit into your own market analysis.
Yeah, hopefully it's demystified it a bit. And maybe final thought to leave you with, now that you understand how the EMA kind of smooths data but focuses on the now,
Mm-hmm.
think about how other ways of weighting data, other mathematical approaches and technical analysis might actually tell completely different stories using the exact same price information.
Interesting, like different lenses.
Exactly. What other lenses or filters might traders use to look at price action, and how could those perspectives change the interpretation you get just from the EMA? Something to maybe explore further.